All right, I love dividends as much as the next guy, but there's a few types of stocks I want you to be aware of that are in the stock market that could be really risky for you or just not good investments. Maybe not a ton of risk, but just not gonna get great returns. That's what we're gonna talk about in this video, okay? First of all, if you're new here, thank you for being here. My name's Austin. I'm a stock market investor and a co-owner of cloudbusinesstweet.com. Okay, glad you're here before the first 100 subscribers. The number 100, who is it gonna be? Number 100. Okay, as a thank you for hitting that subscribe button, I just wanna show you a quick picture of my cat. She's over here off camera. She's being a little wild thing. So if you hear her, don't mind her. She likes to stay in the room while we talk about stocks. She's a stock market investor too. Anyway, let's get into it. So this type of dividend stock that I don't think everyone should buy. We should beware of this type of dividend stock. It's called a REIT, okay? A REIT is a real estate investment trust. That's REIT. So if you see that as an equity type in the stock market, that's what that's talking about. There's two main types. There's an equity REIT and then there's a mortgage REIT. So equity REITs they actually own the buildings, they own the real estate, and then they rent it out to different customers and then they collect rent money, okay? Mortgage REIT, it's financing, right? So they make loans and then they collect interest on those loans. And an interesting thing about REITs is that in order to qualify as one, especially in the public markets, you have to pay out 90% of your profits to your shareholders. So some of these companies will have extremely high dividends for years and years and years. Sometimes their whole time as a public company could be like 6%, 7%, 8%. I've seen as high as like 15 to 18%. Absolutely crazy. So when you look at it and you remember, because you're smart, that the S&P returns about 11% or 10%-ish over a very, very long period of time. It's not going to be on an annual basis, but if you hold for long enough, your annualized return will be somewhere around 10%, right? So when you see a stock that's returning 12% in just cash alone from cash dividend payments, that's really attractive, especially to a younger investor, all right? A lot of people get caught into this trap. It might be too good to be true. And there's one way that's really sneaky that I want to talk about. So a thing that has to happen a lot, since they have to pay 90% of their profits out to shareholders, what they end up having to do is they have to dilute shareholder equity very often. So I'm not going to go too far on this, but I'll just say market cap, okay? Market cap divided by number of shares outstanding, that's how we get the stock price. So let's say you bought into a stock that you thought was a great investment, and it was a REIT, and it was a $25 per share stock. So you bought a bunch of shares at $25 per share, and you had a goal to get up to, let's say, $35 over the next 3 years. That'd be a pretty decent investment. Not great, but decent. But with that 12 to 10% or somewhere around that dividend, that's crazy good returns. So that was your goal. Then you see over a course of time, maybe every 6 months, maybe every 9 months, maybe every 12 months, you see that this company is issuing more shares. And it seems like it's not that huge of a deal unless you really understand what it means to dilute shareholder equity. So I'm going to talk about it for just a sec, okay? Stock price is determined by number of shares outstanding on the denominator, and then on the top, the numerator would be the market cap. Okay, so this company could be becoming more valuable from a market cap standpoint over time because the market's valuing them more fairly. They're getting higher revenues over time, they have higher earnings over time, but the share price might be doing nothing because they might be increasing the shares outstanding every 6 months, every 9 months, every 12 months, they're increasing the shares outstanding. So the math ends up for the denominator to get bigger at the same time the numerator is getting bigger, which means your result from that is dead money at best, right? Dead money. So you might have bought a REIT for $25 3 or 4 years ago. Company's way more profitable. The company's worth a lot more from a market cap standpoint, but you as a shareholder have been diluted so far that you've gotten a 0% return over that time. Sure, you collected your dividend, but you could have collected a 3% dividend and gotten a 12 to 15% gain on something like Disney stock or some other dividend paying stock like Walmart or CVS or whatever. There's a bajillion dividend stocks out there, but instead of buying those stocks, you went for a REIT, and unfortunately, you got diluted to the hilt. So unfortunately, you've made 0% capital gains return, and all you've gotten is the dividend. So it's kind of a trap, right? They kind of keep you in this unfortunate situation where, yes, the fundamentals are getting better, but also they're diluting you so much by issuing all these new shares. So I would really try to look out for that. Be careful, look really deep into this company. Go to macro trends or something like this. You can look it up in Y charts, macro trends, something like that. Just Google shares outstanding for whatever company you're thinking about buying. I personally own some REITs. I don't own any REITs that dilute shareholder equity on a regular basis. If they dilute shareholder equity while I'm holding that stock, I'm heavily considering selling that stock, okay? Especially if it's a REIT. I don't think dilution is the end of the world, period, for every single stock, but when it's a low growth company already, it's a high dividend payer already, this just says to me, this company doesn't have enough money that they're able to hold on to because they're required to pay out 90% of it, that they have to dilute shareholder equity, raise more money so that they can invest in more projects. That's great for the REIT, right? But it's not great for me as the investor, okay? Because I am not getting any share price appreciation. I might as well have taken my money, put it into a different REIT that isn't a serial diluter, or just put it into a common stock where I could have collected a much smaller dividend, but hopefully had a little bit more price appreciation. So that's kind of the main trap with REITs. I just want you to don't fall for the yield trap. A lot of those yields are unsustainable anyway, but even if they are sustainable, a lot of times the share price is dead money, or it's absolutely like over a 5-year span, looking disgusting. Like the share price has decreased. So if you're losing 12% a year on the share price, but you're getting a 12% dividend a year, you're getting exactly a 0% return. That is not a good situation to find yourself in. So if you are going to invest in REITs, spend a lot of time researching the company, make sure they're not diluting on a regular basis, and do everything you can to figure out how safe that dividend is before you buy a REIT stock. All right, that's all I got for you today. Hope you enjoyed this one. Just a little nugget on REITs that I've seen play out over the last few years in the market, especially through COVID. A lot of those stocks are just never coming back to their prior values. All right, and they had to dilute so heavily to stay afloat. Really unfortunate. All right, hope you guys enjoy, and we'll see you next time.